If you had to pick just 3 mutual funds to build long-term wealth, which ones would you choose? Would you go with an aggressive growth fund that hunts for the next big winners? Would you lean on a time-tested active fund with a legendary track record? Or would you focus on generating income that you can reinvest to buy even more shares? The smart answer is all 3. Today, I am going to walk you through 3 different Fidelity funds. Each one is a different engine for building long-term wealth. One hunts for explosive growth. One has quietly crushed the market for decades. And one pays you cash while you wait. Together, they cover aggressive growth, time-tested active management, and reliable income. Hang around as I show you exactly how they work. Fund number 1, Fidelity Growth Company Fund, ticker FDGRX. Let me start with a number that might make you do a double take. Over the past 10 years, this fund has delivered an annualized return of roughly 22%. In some calculations, it has gone as high as 25% in certain periods. To put that in perspective, the S&P 500 over the same time frame delivered around 13%. The difference is enormous. Now, what is this fund actually doing? FGRX is an aggressive large-cap growth fund. It invests primarily in common stocks of companies that Fidelity believes have above-average growth potential. Think technology leaders, innovative healthcare companies, and disruptive consumer brands. The fund focuses on businesses that are growing their earnings much faster than the market average. Of course, that kind of performance does not come for free. The expense ratio is 0.69%, which is actually lower than the category average, but it is higher than an index fund. And here is the honest truth about FDGRX. In its best years, it gained over 67%. In its worst year, this fund lost nearly 34%. That is a stomach-churning drop. This fund is for investors who have a long time horizon, at least 10 to 15 years, and investors who can stay calm when the market gets scary. If that sounds like you, FDGRX is a powerful long-term fund that can build you generational wealth. The next will inspire you even more on your investing journey. Fund number 2, Fidelity Contra Fund, ticker FCNTX. Now let me introduce you to a fund with a different kind of reputation. Fidelity Contra Fund is one of the most celebrated actively managed funds in the world. For more than 35 years it was run by a legendary manager named Will Danoff. Under his leadership, the fund delivered a cumulative return of over 10,500%. That is not a typo. 10,500%. Since its inception, FCNTX has generated an average annual return of roughly 13.3%. Over the last 10 years, it has delivered around 16.6% annualized, consistently beating the S&P 500, which averaged about 12.6% over the same period. In 2025 alone, the fund was up roughly 22%. So what is the strategy behind this fund? The name gives it away. Contra Fund invests in companies whose value Fidelity believes is not fully recognized by the public yet. It goes against the crowd. It buys what others hate when the fundamental story is strong. The fund invests in both growth stocks and value stocks, giving its managers a wide range of opportunities. Now, there is important news here. Will Danoff announced that he will retire at the end of 2026. He will hand the reins to 2 experienced co-managers, Jason Weiner and Asher Anolik, who have been working alongside him. That is a significant change. But Fidelity has a deep bench of talent, and this transition has been carefully planned. For long-term investors, FCNTX remains a compelling choice, especially when paired with other funds that diversify your risk. Fund number 3, Fidelity High Dividend ETF, ticker FDVV. Now let me show you the income engine. FDVV is not a mutual fund. It is an exchange-traded fund, or ETF, which means it trades like a stock and tends to be more tax-efficient in taxable accounts. This fund seeks to track the performance of the Fidelity High Dividend Index, which focuses on large and mid-cap dividend-paying companies that are expected to continue paying and growing their dividends. The current dividend yield is roughly 2.9 to 3%. That does not sound huge on its own, but here is where it gets interesting. The dividend growth rate over the last few years has been around 9%. That means the cash payout is growing quickly. The fund pays dividends quarterly, so 4 times a year you get cash deposited into your account. What does FDVV actually own? Its top holdings include companies like Nvidia, Microsoft, and Apple. So you are getting exposure to some of the world and #39's best technology companies while also collecting a dividend check. The fund holds about 107 stocks, with heavy weightings in technology, financial services, and consumer defensive sectors. The expense ratio is 0.15%, which is very reasonable for a dividend-focused ETF. And, importantly, FDVV has outperformed some better-known dividend ETFs on total return, meaning that price appreciation plus dividends combined have been very solid, putting all three together. Now let me show you how to combine these 3 funds into a single long-term wealth building portfolio. Each fund plays a different role. FDGRX is your aggressive growth engine. It hunts for companies that can grow earnings faster than the market. You want this fund to be a meaningful part of your portfolio if you are in your 20s, 30s, or 40s. FCNTX is your active management core. It goes against the crowd and finds value where others do not see it. This fund provides a different kind of return stream than a pure growth fund. FDVV is your income generator. It pays you cash each quarter, and you can reinvest those dividends to buy more shares of all 3 funds. Here is one sample allocation for younger or mid-career investors. Put 50% into FDRX for aggressive growth. Put 30% into FCNTX for active, contrarian exposure, and put 20% into FDVV for the income drip that buys you more shares over time. With this mix, you have growth, active management, and income all working together. For a more balanced long-term approach, you could do 40% FDGRX, 40% FCNTX, and 20% FDVV. The exact numbers depend on your age, your risk tolerance, and your goals. But the principle is the same. Do not put all your eggs in one basket. Let these 3 different engines work together. No portfolio is right for everyone, so let me be honest about who should think twice. If you are already retired and living off your savings, FDGRX might be too aggressive for you. A 34% drop in a single year is not something a retiree wants to experience. For retirees, a much heavier allocation to FDVV and bonds would make more sense. If you are an extremely conservative investor who loses sleep over market volatility, then FDRX is probably not for you. Stick with broader index funds or target date funds instead. And with FCNTX, the upcoming manager transition is something to watch. The new team is experienced, but change always introduces uncertainty. If that makes you nervous, you might want to wait and see how the transition plays out before committing a large portion of your portfolio. Now let's talk about how to get started. If this approach makes sense to you, here is what you should do. Step 1. Open a Fidelity account if you do not already have one. These funds are available there, with no transaction fees. Step 2. Decide on your allocation. Start with a simple 50-30-20 split or something similar. You can always adjust later. Step 3. Set up automatic monthly investments. Consistency matters more than timing. Buying a fixed dollar amount every month, regardless of what the market is doing, is the single best habit for long-term wealth building. Step 4. Reinvest your dividends. FDVV pays you cash every quarter. Tell your brokerage to automatically reinvest those dividends into more shares of all 3 funds. That is how compounding really takes off. FDGRX, FCNTX, and FDVV. 3 different funds. 3 different approaches to building wealth. One hunts for explosive growth. One goes against the crowd and finds hidden value. And one pays you cash while you wait. You do not need to pick a single winner. You can own all 3. Let them work together. Let the growth fund do its thing. Let the active fund find opportunities you would never see on your own. And let the dividend fund fuel the entire machine with cash that buys more shares. If you could own an aggressive growth fund, a legendary active fund, and a growing income, stream all at once, with just 3 tickers, the only real question is, what are you waiting for? If this video helped you think about your investments differently, hit the like button and subscribe. We have one more video in this series coming up, covering how to build the ultimate set and forget portfolio using Fidelity funds. You do not want to miss that.